In 1997, an economist named Fred Foldvary made a prediction that should have seemed insane. Writing in the American Journal of Economics and Sociology, he stated with remarkable precision that the next major economic depression would occur around 2008. Not sometime in the next decade, not probably within 10 years. He gave a specific time frame, 11 years before it happened. Most economists laughed. Financial analysts dismissed it. The economy was booming. The dot-com bubble was inflating. Everyone was getting rich. The idea that someone could pinpoint an economic crash more than a decade in advance seemed like astrology, not economics. But in late 2007, cracks appeared in the housing market. By September 2008, Lehman Brothers collapsed. The global financial system nearly imploded. Foldvary had been exactly right. How? What did he see that everyone else missed? The answer lies in a pattern that's been observed in economic data for over 200 years. An approximately 18-year, the real estate cycle that repeats with striking regularity, driven by forces that have nothing to do with technology, government policy, or modern financial instruments. And if that pattern holds, the next downturn is likely coming around 2026, not 2027, not 2025, approximately 2026. The pattern appears to be playing out similarly to how it did before 2008, before 1990, before numerous major downturns going back to the early 1800s. Once you see it, you can't unsee it. And in late 2025, standing roughly 18 years after the 2008 collapse, multiple indicators suggest the pattern may be completing once again. The 18-year real estate cycle wasn't discovered by Foldvary. He drew on research that dated back over a century. In the 1,930 seconds, economist Homer Hoyt conducted extensive analysis of the Chicago real estate market and documented something remarkable according to his published research. Real estate prices didn't move randomly. They appeared to follow a predictable rhythm, rising and falling in cycles that averaged approximately 18 years from peak to peak. Hoyt documented this pattern stretching back to 1,800. The cycle wasn't perfect. There were disruptions from major wars and catastrophic events, but it was remarkably consistent. Every 18 years, roughly, real estate prices would peak, speculation would reach fever pitch, and then the market would crash, often dragging the entire economy down with it. The Panic of 1819, the Panic of 1837, the Depression of 1873, the Panic of 1893, the crash of 1907. Each occurred approximately 18 years after the previous peak. The pattern experienced disruptions during the Great Depression and World War II, massive events that threw off the rhythm. But afterward, researchers observed it resuming. Peak around 1954, peak around 1973, peak around 1989, and then, consistent with the pattern, peak in 2006, followed by the collapse of 2008. Approximately 18 years between major peaks. Again and again. But why 18 years? Why not 15 or 20 or 25? What makes this specific time frame so consistent across centuries? Foldvary's explanation drew on both Austrian economic theory and the teachings of Henry George, a 19th century economist who understood the central role of land in boom-bust cycles. The mechanism is elegant once you understand it, and it reveals why the cycle persists regardless of technological change or policy interventions. Land is fixed in supply. This is the foundational truth that drives everything else. You can build more houses, more factories, more office buildings. Engineers can construct taller skyscrapers. Developers can create larger shopping centers. But you fundamentally can't create more land, at least not in desirable locations where people actually want to live and work. This fixed supply means that as the economy expands, much of the economic gain gets captured not in wages or profits, but in rising land values. When businesses become more productive, when populations grow, when incomes rise, demand for land increases. Families want homes, companies need office space, retailers require storefronts, manufacturers seek factory sites. And because the supply of prime real estate can't increase to match this growing demand, prices rise. At first, this is healthy and reflects genuine economic expansion. Land values are simply tracking real growth in the underlying economy. But then psychology kicks in, and this is where the cycle becomes inevitable. Speculators notice that land prices are rising. They begin buying not to use the land themselves, but to sell it at a profit to someone else. This speculative demand, layered on top of genuine use demand, pushes prices even higher. Higher prices attract more speculators. People who see easy money being made and want their share. This creates a self-reinforcing boom where rising prices justify more buying, which causes more rising prices. Credit expansion accelerates the entire process dramatically. Banks lend more, eagerly during good times, when collateral values are rising and defaults are rare. Much of that borrowed money flows into real estate, considered a safe investment because land is tangible and prices have been rising. The availability of easy credit allows buyers to bid prices up far beyond what they could pay from savings alone. Someone might have $50,000 in cash but can borrow $400,000 to buy a property worth $450,000. That leverage multiplies the upward pressure on prices. Eventually, inevitably, land values rise beyond what people who actually want to use the land can afford to pay. A business looking to expand calculates that the rent on prime downtown office space would consume all its potential profit. A young family realizes that buying even a modest starter home would require mortgage payments they simply cannot manage. Development slows because the numbers don't work anymore. Projects that made sense when land was cheaper become unprofitable at inflated prices. And when the speculative buyers, the people who bought purely expecting prices to keep rising, realize that prices have peaked and the momentum has stalled, they try to sell. But here's the trap. There are no buyers at those inflated prices. The people who wanted land to actually use it were priced out long ago. The only buyers were other speculators, and they're all trying to sell now too. The market freezes, transactions stop, and when some sellers get desperate enough to accept lower prices, the decline begins. Real estate crashes don't happen overnight. They grind downward over months or years. Construction stops, throwing workers out of jobs. Developers who borrowed heavily to buy land at the peak face bankruptcy. Banks that lent money secured by property suddenly have collateral worth less than the outstanding loans. They tighten lending standards, making it harder for anyone to get credit, which further depresses prices. Workers laid off from construction spend less, hurting retailers and service businesses. The contraction spreads through the entire economy like a poison moving through a body. The recovery phase takes time because the excess must be worked off. Overbuilt properties must be absorbed, debts must be restructured or written down. Speculators must exit the market. Only when prices fall far enough that actual users, families wanting homes, businesses needing space, find them affordable again, does genuine demand return. This cleanup process typically requires several years, during which the economy operates below its potential capacity. The 18-year timeframe, according to researchers who've studied this pattern extensively, reflects how long this entire cycle takes to play out under normal conditions. Roughly 4 to 7 years for recovery from the previous bust, as the market finds a bottom and genuine users start buying again. Another 7 to 8 years of gradual expansion as the economy rebuilds, employment grows, incomes rise, and real estate prices increase in line with fundamentals. Then 3 to 4 years of speculative boom as memory of the last crash fades, credit loosens, and everyone forgets that prices can fall. Finally, the collapse. Add it up, and you get approximately 18 years from peak to peak, with remarkable consistency across different eras. Foldvary studied this cycle in detail. In his 1997 paper, The Business Cycle, a Georgist-Austrian synthesis, he noted that the 1990 recession had marked a real estate peak. Adding 18 years gave approximately 2008 as the next likely downturn. His exact quote was, "The next major bust 18 years after the 1990 downturn will be around 2008 if there is no major interruption such as a global war." He published this prediction when the economy was strong, when real estate was rising, when suggesting a 2008 collapse seemed ridiculous. But he understood the pattern, and when 2008 arrived, consistent with his time frame, his prediction became legendary. Before his death in 2021, Foldvary suggested another prediction based on the same cycle. The next downturn, following the approximately 18-year pattern, would likely occur around 2026. 18 years after 2008. The cycle would repeat unless something catastrophic intervened, a major war, or unprecedented disruption. But absent such events, 2026 was the time frame to watch, according to the pattern's historical rhythm. So where are we in the cycle now? According to the four-phase structure that researchers have identified through historical analysis, the cycle breaks down as follows. Phase 1 is the recession or depression phase, typically lasting 1 to 2 years. This is the cleanup phase after the crash, when foreclosures happen, bankruptcies process through courts, and prices find their bottom. It's painful but necessary. The excess gets purged from the system. Phase 2 is recovery, lasting approximately 7 years. During this phase, prices stabilize and then begin rising slowly from depressed levels. Confidence gradually returns as people see that the world didn't end, that markets function, that opportunity exists. Banks begin lending again, cautiously at first. Developers start small projects, testing the waters. Families who've been saving feel comfortable buying homes again. This phase is characterized by slow, steady, sustainable growth. Phase 3 is the expansion or boom phase, lasting another 7 years approximately. This is when everything seems wonderful. Prices rise steadily year after year, employment is strong, incomes grow, credit is readily available, everyone who bought real estate is making money, which encourages more buying, the media celebrates the boom. Ordinary people start viewing real estate as a can't-lose investment. Flipping houses becomes a hobby, then a profession for some. This phase feels permanent while you're in it. Phase 4 is the blow-off or mania phase, lasting 2 to 3 years. This is when caution gets thrown completely aside. Prices rise at accelerating rates. Stories emerge of people making fortunes in months. Lending standards deteriorate as competition among lenders drives them to offer increasingly risky loans. No documentation loans appear. Stated income loans where borrowers simply declare their income without proof. Interest-only loans where payments don't reduce principal. These innovations allow buyers with no business owning expensive properties to bid prices up even further. Speculation reaches fever pitch, and then, often quite suddenly, the music stops. The 2008 crash clearly brought Phase 1. The recession lasted officially from December 2007 through June 2009, though the housing market continued declining through 2011 or 2012 inches many regions. Recovery, Phase 2, began around 2012 and extended through approximately 2019, roughly 7 years. That recovery was slow, frustrating for many, but it represented the typical rebuilding phase. Prices stabilized, then rose gradually from depressed levels. Banks tightened lending standards after the disaster of subprime lending. Buyers were cautious, requiring real down payments and documentation. Then came 2020 and the pandemic, which temporarily disrupted everything but paradoxically didn't break the underlying cycle. Instead, massive government stimulus and Federal Reserve intervention, combined with a sudden shift in housing preferences as remote work became common, accelerated the cycle dramatically. Home prices surged in 2020, 2021, and 2022. Real estate speculation reached levels reminiscent of 2005 and 2006. Bidding wars became common. Buyers waived inspections and offered tens of thousands above asking prices just to win contracts. This suggests that Phase 3, the expansion, effectively extended from 2012 through perhaps 2022 or early 2023, and Phase 4, the speculative blow-off, that occurred during the pandemic boom of 2020 through 2022. If that interpretation is correct, and market observers studying the cycle believe it is, we should now be approaching or entering the crash phase. Late 2025, standing roughly 18 years after 2008, with home prices elevated after a speculative surge, with the economy now showing signs of weakening, fits the historical pattern with uncomfortable precision. The trajectory looks remarkably similar to 2006 to 2007, when the market cooled gradually for over a year before the violent collapse of 2008. But patterns aren't proof. What matters is whether current economic indicators support the cycle's prediction. And here's where it gets disturbing. They do. Multiple independent measures, from recession probabilities to employment data to leading economic indicators, all suggest 2026 is a danger zone. According to Bankrate's survey of economists in late 2025, the U.S. economy faces a 39% probability of entering recession by September 2026. That's up from 35% the previous quarter and 26% at the end of 2024. The trend is rising. J.P. Morgan initially assessed a 60% recession probability, later revised to 40%. Even at 40%, those are elevated odds. Corporate chief financial officers, the people running actual businesses, are even more pessimistic. A CNBC survey in March 2025 found that 60% of CFOs expected recession in the second half of 2025, with another 15% expecting it in 2026. These aren't theorists. These are practitioners making real-time decisions about hiring, investment, and strategy based on what they're seeing in their businesses. The employment picture is deteriorating exactly as you'd expect before a recession. Job growth in July 2025 was just 73,000, far below the 200,000 monthly pace needed to keep unemployment stable. The Bureau of Labor Statistics revised previous months downward by a combined 258,000 jobs. Unemployment has ticked up to 4.2% from lower levels earlier in the year. By September 2026, economists project unemployment climbing to 4.6% with job growth, averaging just 49,000 monthly. The yield curve, one of the most reliable recession predictors, has been inverted for an extended period. When short-term interest rates exceed long-term rates, it signals that markets expect tighter monetary conditions and economic contraction ahead. The yield curve has remained inverted through much of 2024 and 2025, suggesting recession risk extending into 2026. Manufacturing executives are particularly bearish. According to surveys, 84% of U.S. manufacturing executives forecast a recession by 2026, with nearly half expecting it to commence as early as 2025. Manufacturing often leads the broader economy into recession, and when an overwhelming majority of manufacturing leaders see trouble ahead, it's worth paying attention. The Conference Board's leading economic index, which aggregates multiple forward-looking indicators, has been declining. This index includes measures like building permits, consumer expectations, stock prices, credit, conditions, and manufacturing orders. When the LEI falls consistently, recession typically follows within 12 to 18 months. The LEI has been sending warning signals through 2024 and into 2025. Consumer confidence hit a 12-year low, according to recent measurements. When consumers lose confidence, they pull back spending. Consumer spending drives roughly 70% of U.S. economic activity. If consumers retrench, recession follows almost inevitably. The fact that confidence is at decade-plus lows while unemployment is still relatively low suggests people are sensing something in the economic environment that hasn't fully manifested yet. Housing inventory, specifically unsold homes, has reached levels last seen in 2009 during the depths of the housing crash. When inventory rises while prices remain elevated, it suggests demand is weakening while supply continues growing. This imbalance typically resolves through falling prices, which triggers the real estate crash that the 18-year cycle predicts. Credit spreads remain tight, which usually indicates complacency rather than concern. Investors are still willing to lend to risky borrowers at rates barely above safe government bonds. But historically, tight credit spreads just before a recession suggest that markets aren't pricing risk appropriately. When reality hits, spreads blow out rapidly as everyone tries to reduce risk simultaneously. The tariff policies implemented in 2025 add another layer of risk that compounds the cyclical pattern. Economists from multiple institutions have warned that tariff levels approaching those of the Smoot-Hawley era in the 1,930 seconds could significantly damage growth while fueling inflation. This creates the nightmare scenario of stagflation, high inflation plus recession, which limits the Federal Reserve's ability to respond. Deloitte's economic forecast explicitly models a scenario where the economy enters recession in the fourth quarter of 2026, driven by persistent inflation, forcing the Fed to raise rates despite weakness, exactly matching the 18-year cycle's timing. Their analysis projects unemployment averaging 5% in 2027, with output not returning to previous highs until the first quarter of 2028. The pattern isn't just about timing, it's about the specific sequence of events, and that sequence is playing out now. Real estate prices rose dramatically from 2012 through 2022. Speculation reached extreme levels during 2020 through 2022, with buyers competing frantically, paying above asking prices, waiving inspections. That was the blow-off phase. Since 2023, the market has cooled. Mortgage rates spiked above 7%. Sales volumes fell. Inventory rose. Prices haven't crashed yet, but the conditions for a crash are assembling. This matches perfectly with what happened in 2006 and 2007, when the market cooled for over a year before the violent collapse of 2008. The global dimension adds urgency. When Foldvary first wrote about the 18-year cycle, he noted similar patterns in other developed countries. The UK, Australia, and other nations with market economies experience comparable real estate cycles, often synchronized with the US. This suggests the mechanism isn't uniquely American. It's inherent to how market economies handle land and credit. A 2026 crash starting in the US would likely trigger cascading effects globally, just as 2008 did. Skeptics might argue that modern financial regulation has made the system more stable. After 2008, regulations like Dodd-Frank imposed stricter capital requirements on banks. Stress tests force banks to prove they can survive severe downturns. Central banks have better tools and more experience responding to crises. Perhaps these changes have broken the cycle. But the 18-year cycle isn't driven by banking regulation. It's driven by the fundamental dynamics of land as a fixed resource and human psychology around speculation. Those haven't changed. People still speculate when they see prices rising. Credit still expands during booms. Land supply is still fixed. The cycle's mechanism remains intact, regardless of financial regulation. Moreover, regulations introduced after one crisis often create vulnerabilities that cause the next one. Post-2008 regulations focused on banks, but left shadow banking relatively untouched. Private credit markets, which operate outside traditional banking supervision, have grown enormously. These markets may harbor risks that regulators don't fully understand, risks that could amplify the next downturn. So what happens if the pattern holds and 2026 brings the crash? Based on previous cycles, here's the likely sequence. First comes the shock. Something triggers recognition that the boom has ended. In 2008, it was Bear Stearns' collapse followed by Lehman Brothers' bankruptcy. In 1990, it was the savings and loan crisis. In 2026, the trigger could be a major bank failure, a corporate bankruptcy revealing hidden leverage, a geopolitical shock, or simply the slow accumulation of weak economic data finally convincing markets the downturn is real. Second comes the cascade. Once the crash begins, forced selling accelerates it. Highly leveraged investors must sell assets to meet margin calls. Those sales push prices lower, triggering more margin calls, forcing more selling. Credit markets freeze as lenders pull back, unsure who's solvent. The financial system seizes up just when the real economy needs credit most. Third comes the recession. As credit contracts and asset prices fall, businesses cut investment and hiring. Consumers, seeing their wealth decline and fearing job losses, reduce spending. The economy contracts, validating everyone's fears and making the downturn worse. Unemployment rises. Corporate profits fall. Tax revenues decline while government spending on unemployment benefits and other safety nets rises. Budget deficits explode. Fourth comes the recovery. Eventually, prices fall far enough that buyers return. Debts get restructured or written off. The worst performers exit through bankruptcy. The survivors, stronger and leaner, begin growing again. The Federal Reserve cuts rates aggressively. The government implements fiscal stimulus. Slowly, painfully, the economy stabilizes and begins recovering. This typically takes 1 to 2 years from the crash, meaning if 2026 is the crash, recovery might begin in 2027 or 2028. Finally comes the next cycle. As recovery takes hold, confidence returns. Prices begin rising again, credit expands, speculation gradually rebuilds, and about 18 years later, the pattern repeats. None of this is certain. Patterns can break. Unprecedented policy responses might succeed where previous interventions failed. The 18-year cycle has been disrupted before, though only by world wars and catastrophic events. Without such disruption, the cycle has held remarkably consistent for over 2 centuries. What makes Foldvary's prediction compelling isn't just the historical pattern. It's that the pattern explains the underlying mechanism. Real estate cycles aren't random. They're driven by the interaction between fixed land supply, credit expansion, and human psychology. Understanding that mechanism allows prediction in a way that simply extrapolating economic trends doesn't. The pattern says 2026 is the year. Current economic indicators, from recession probabilities to employment trends to housing inventory to corporate pessimism, all point in the same direction. The sequence of boom, speculation, cooling, and now weakening fundamentals matches previous cycles. Unless something unprecedented intervenes, the hidden pattern that predicted 2008 11 years in advance is predicting 2026 now. If you're paying attention, if you understand the cycle, this gives you time to prepare. Not time to panic, but time to position yourself appropriately. Reduce leverage, build cash reserves. Avoid speculating in assets that depend on continued economic expansion. Focus on defensive investments. Prepare for opportunity, because crashes, while painful for many, create enormous wealth-building chances for those who have capital when assets hit bottom. The pattern isn't hidden anymore. It's been documented, analyzed, and tested against 2 centuries of data. Foldvary unlocked it, applied it, and proved its predictive power. Now, standing in late 2025, 18 years after 2008, with every warning sign flashing, the pattern says one thing clearly: 2026 is coming. The cycle is completing. and those who understand it will be ready while everyone else scrambles to understand what happened. If this gave you a new perspective on economic cycles and why 2026 specifically matters, hit that subscribe button. Understanding the pattern that's been hiding in plain sight for 200 years might be the most valuable financial knowledge you can gain. The cycle doesn't care whether you believe in it. It just keeps repeating. And right now, it's pointing straight at l'untienling archelot.